Let's play this. Let's play this voicemail quick.
Hey Brad, I just got a sign for a covered call I had. I could use the wheel strategy and buy a covered put to get the stock back, but is a leaps option just as a valid strategy and sell covered calls against it? When do you decide to use leaps versus covered puts? I reviewed your leaps video again and mulling about a decision. Thanks.
I love this question. It ceases to amaze me, like how I thought that I could think of every scenario. Right. That's what I'm going back and forth about when I try and make videos. I'm trying to like think of things that people would ask, and just when I think I know every type of question that can be asked, I get a question like this. An amazing question and something that I've never really thought about. And we talked about it last week too. That question that I'd never heard before with the out of the money, which we now know, I misconstrued what that guy was saying, but it's just so amazing. So that's, guys, another reason why I'm asking you, please leave a voicemail, because a lot of the times you're helping me make content, you're helping me, scale out to many different people. And this is a great example. A very, very simple question, something that happens all the time with options, but something I never thought to do a video or really even talk about at all. So let's do that. To reiterate, he was doing the wheel strategy. So for those of you that are new to the wheel strategy, we're going to write calls. And then when we get assigned, we have to sell off our shares. Then we're going to write puts. And when we get assigned, we're going to have to buy those shares back. And it's pretty much a flip-flop. Sell 100 shares, buy 100 shares. Sell 100 shares, buy 100 shares. And during that whole time, you're collecting premium from the buyer of that options contract. And our hope is that we kind of buy and sell around the same cost basis, right? So even as the stock goes up, we get assigned on a call, we do the put. So he just got assigned. So the next step in the wheel after getting assigned on a covered call is now to make a cash secure put. Awesome. Okay. But he's saying, all right, Brad, I'm watching your videos and you don't really do that anymore, right? You're not really doing the wheel. You're into the leaps options. Instead of writing a put, should I buy a leaps option and get into the poor man's covered call? That's what I'm getting from the question. And here is my answer. And I once again, I love it. Every sport has a ball, and it has its own specific ball that's unique to that particular sport. I personally, and this might not be everyone's opinion, I personally believe that every option has a stock that is good for that particular option strategy. I personally believe some stocks are better for trading the wheel. Here's a couple of examples of the types of stocks. I can tell you the ones that I'm trading. I don't need to necessarily get into why, but I particularly like to trade the wheel strategy with stocks that trade pretty flat. Not a lot of movement. In my early days, it was things like AT&T, for example. Right now, I'm doing it a lot with value stocks, things like Intel. These types of stocks that aren't going to move around that much make it much easier to stay close to that basis that I was saying, because we don't want to get assigned on a call and it shoots way up, because now the put that we sell has to be way up as well. So now we're spending more money to buy 100 shares back. The other way is a bag hold. If you're doing cash secure put and say you have a strike price at $20 and it dives to 10, that's a big jump. That's a 50% jump. Now you have to bag hold on that 50% jump. We don't want that. So I tend to only wheel stocks that trade pretty flat. The other types of stocks that I think that I want to do this with are dividend stocks, because when we buy options, we own options contract. We don't own the shares. So we do not get dividends when we buy a leaps option. When we do the poor man's covered call, we do not get dividends. Where when you're trading the wheel and you have 100 shares, you do a covered call, and the ex-dividend goes by, you still own those shares. So you're going to get yourselves that dividend. On the cash secure put side, you don't own the shares, right? You own a contract that says that you might have to buy 100 shares later. You do not get dividends in that case. But if we put those two things together and we take blue chip dividend paying stocks, we find ourselves in an amazing position to trade the wheel strategy. We are going to have something that our basis kind of stays the same. Like what AT&T stayed at like $25 to $28 for like 5 years. Blue chip dividend stock. And every once in a while, we're going to get paid a dividend. If you don't want the call to come, just pay attention to the ex-dividend date and don't write a covered call during that time so that you get to keep your dividends. There's that to look at. What kind of stock did you just get assigned on, right? Because if you do a LEAPS option with a blue chip steady stock, well, with that low volatility is going to come low options premium, and it might not be worth your time to write calls against it. That LEAPS option, in a LEAPS option, when we buy options, we need that share price to go up, among other things, to raise the value of that option so that we can sell to close it later. If you buy a LEAPS option with AT&T, and I just keep using that, like we're going pre-dividend cut AT&T. If you do that, it's not going to, we can do another stock, talk Intel, like that I have options with, or Hewlett-Packard. I have LEAPS because I think they can go up. But for Intel, I don't think they're going to grow that much. So I'm more likely to trade the wheel with them than I am a LEAPS option because I don't really have that much confidence that it's going to shoot up in the near future or even for a year, right? Because we're waiting for the bubble to pop, right? We're waiting for this big correction. And if you look at the stocks that I'm doing LEAPS options with, I kind of thought about that. Like in a market correction, are people going to stop going to Starbucks? I still think that company's revenue is still going to continue to grow. I still think they might be okay. People are going to stop buying Pepsi and all the other conglomerates that Pepsi owns in a stock correction. I mean, they're not terribly overvalued. So think about what kind of stock you have. If you have yourself an assignment on a blue chip dividend flat paying stock, I probably would just write the put. And I'd also think about where the share price is in relation, because the closer to the share price, the better premiums we're going to get. And if you had like a $20 strike price and your call got assigned at like 30, well, you want to write your call at your assignment price, right? So if you go to write your call at your assignment price, the share price might be so far away that you're getting no options premium, right? So it's not really going to be worth it in that case. Then we try and get greedy and we start making things above our basis and things get a little bit ugly. What the assignment price is something that you really need to think of. How close to our basis are. If you had a $30 strike price and it got assigned at like $30.50, write the put. Right? If it's a weekly, what's next week? Get assigned, get those stocks back, whatever. If you did this with a stock that does have the possibility to grow and grow and grow, and it does have a little bit of volatility in the market, and it does have pretty nice options premiums when you click sell call in the options chain, and you think you can make a couple bucks back, and then you go back and you see the history of implied volatility, and you do all the things that you should be doing before you buy an option, buy a LEAPS option. If all of those things work out, then hell, go to LEAPS. Right? With the LEAPS option, we want things that probably don't pay dividend because, right, if we're going to own dividend stocks, we want to get dividends. Now, are there stocks that aren't, quote, dividend stocks? Yeah, well, for me, it's like over 3% I consider a dividend stock. Like Apple, do they pay dividend? Yes. Are they dividend stock? Not in my opinion. Right? So if you have one of these stocks that doesn't pay a dividend, that has the opportunity or the potential to grow, that's great. Because in our case, like you can go far enough in the money with your LEAPS option that maybe you only need 1% to 2% growth in the next year. If you think that's going to happen and you can get some pretty good covered calls against it, hell, go the LEAPS option. I personally trade the wheel with flat dividend paying trading stocks, or at least things that move so slow or steady that I can almost predict what's going to happen on a weekly basis, right? Because the wheel, I'm usually selling weeklies. So I don't have to worry about like long term. Like all you really need to worry about is Monday to Wednesday, right? Because for me, I'm going to be closing most of my options anyway by Wednesday. So I only need to, quote, worry about that stock for 3 days. I guess the last one for the LEAPS options, stocks that don't pay a dividend, stocks that are more likely to grow. And this could either be a tech stock or it could be a small cap stock that you think really can explode, because then you could really do yourself a bunch of favors if the stock does really, really well. Take, for example, my $5 calls with Vuzi. At one time, once upon a time, yes, shoulda, woulda, coulda, that share price was close to $30. And I think I was up like 3,000% on that option. Didn't sell. So right now I'm sitting at 87%. for that option, and it doesn't expire until January of 2023. Doesn't pay a dividend, has the opportunity to grow. With the poor man's covered call, you don't want it to grow too fast because then managing that short call can be really annoying, really annoying. So leaps are great for these blue chip growers or these tech stock, these huge companies that you know is going to grow. They're going to grow. Even if we take a correction over the course of a year, 2 year, they're probably going to grow, right? There's a lot of probabilities and things like that, and anything can happen. That's the risk of any investment. But I think if I was going to give you advice, like I'd want to know some of those stocks, but I think you could take those with you, right? Look at the stock. Is it dividend flat, or is it going to grow steadily over time? Does it pay a dividend or not? And also, what is the premium that you have to pay? Like, what is that leverage if you go deep in the money to 0.75 delta or 0.8 delta? How much of a discount are you really getting on the 100 shares? Are you getting that 85 delta for 25% of what 100 shares would cost you? Shit, that sounds like a great deal to me. Or maybe, and this is the last piece I'll give you with this particular situation, maybe you're new to options and you haven't really learned everything yet. I forget what I was reading, and I did not come up with this. I'm reiterating somebody, and it might come to me. When I watch YouTube, I watch a lot of like self-reflection type of things and like self-help and also a lot of entrepreneurial stuff. And we're talking about starting a business is like there's many steps to this. Let's say there's 10 steps to starting a business or 10 steps to getting to a really, really successful business. And most of the people do not start a business because they start their journey on step 2. And they look at step 2 through 10 and get overwhelmed. When in all actuality, all they needed to do was get step 1 done. For YouTube, it's take out your phone, hold it out in front of your face and start recording yourself and then post it on YouTube. That's step 1. But some people are like, I can't start a YouTube channel. I don't have a camera. I don't have lights. I don't have a microphone. I don't know how to edit. And boom, they never start a YouTube channel. I didn't know that shit when I started a YouTube channel. I don't know most of it now. The same holds true with options. If you are starting the wheel, and I see this, and this is a major flaw that I see in the Discord, right? We look at the end result. We look at my 106% return for the year. But what people fail to realize is that I've been doing this for 4 years. That before I ever bought a Leaps option, I traded the wheel for 3 years first. Now, when I was doing that, did I see people buying Leaps and buying options and doing grand things with it? Yeah. Did I want to get in on the action? Hell yeah. But I did have enough discipline with money to know that I wasn't ready. Maybe it's my background in education. I knew I wasn't ready. So maybe this is like the first time you've ever been assigned. And maybe you've never completed a full wheel where you went call to put. Right? Maybe you're still learning. Then hell, it's time to continue. You got to keep learning. Right? Go through a wheel. Go through a wheel. I made more money trading the wheel than I did with Leaps as far as like short term. Because the wheel, you can speed that process up. You can speed up your wheel. You can close and roll and get a bunch of different stocks. Granted, you could do this with the wheel, but with that Leaps option, we need things to happen. We need stocks to go up. So it's like I remember making videos that I was, making $250 a day or, that I was making $3,000 a month. I can't make that video anymore because I don't have the put side of the wheel. Right now I make $1,500 instead of $3,000 because I only have the covered calls. And not only that, but I close them at a smaller percentage of profit than I did with the wheel. Right? With the wheel, I'm closing my options at 70%. With Leaps, I'm closing them at 40%. So I've switched my goal of money making to those Leaps options in long term as opposed to the wheel and getting money on both sides of the call and the put. Maybe you're there. Maybe you're not ready for the Leaps option yet. And it's also, I think you can make more mistakes in the wheel. I think there's more favorable wheel stocks than there are Leap stocks and poor man's cover call stocks, in my opinion. I think it's harder to find, and this is just from personal experience, you can really do the wheel with any stock. You own 100 shares of a stock, you can trade the wheel with it. And you probably do okay. Really. Unless you have something like a huge, incredible amount of unrealized capital gains, you're probably going to be okay. But that's not true for the poor man's covered call and Leaps options. There's a much smaller pool. Now, with that much smaller pool and that more due diligence comes the potential for more profit. Yeah. But just remember, whatever decision you make, it could change in a week. Right? It could change in a weekly. That's it. You can have the same talk with yourself in 2 weeks, right? You get a sign on this put, get a sign on a call, and then boom, it's not even October, and we could be having the same exact conversation. And if you're new to trading options, in that 2 weeks, you can learn so much about the Leaps option and the poor man covered call and be in a much better position to make the right move than you were currently today. Thank you so much for leaving me the voicemail, man. I appreciate it.